Picture this: high-stake trading floors, billion-dollar gambles, and the unyielding chase for profit. Steve Diggle, his name synonymous with defying the odds during one of the most chaotic financial eras in history. From building an empire from the ground up to mastering the art of thriving in the market turmoil. This is the crazy story of how one man revolutionized the world of Asian hedge funds and turned volatility into an unrivaled success. It's 2001, the world is riding the wave of a new millennium. And in the bustling financial hub of Singapore, two seasoned financiers, Steve Diggle and Richard Magades, are about to launch something that will redefine hedge fund success in Asia. With $4 million in seed capital and a bold vision, they established Artradis Fund Management, a name that would soon become synonymous with brilliance, daring, and innovation in the volatile world of hedge funds. But Artradis wasn't just another hedge fund, it was a revolution in strategy, a masterstroke of ingenuity. Diggle and Magades weren't playing the traditional game of chasing high returns of riding market trends. Instead, they set out to harness the beast of volatility itself, turning market chaos into unparalleled opportunity. A hedge fund like no other. Artradis specialized in long volatility strategies, a daring approach that embraced the unpredictable. Through market-neutral tactics like index arbitrage, volatility dispersion, and convertible bond arbitrage, Artradis thrived where others stumbled. They weren't just making bets, they were building a fortress of risk management designed to profit from rare extreme market events. Within just a few years, Artradis exploded onto the global financial stage, growing its assets under management from a modest $4 million to a staggering $4.7 billion by 2008. Its flagship funds Barracuda and AB2 became household names in the hedge fund industry, celebrated for their market-neutral brilliance and ability to thrive during periods of uncertainty. Steve Diggle goes on to explain that they were looking for the cracks in the system, those rare moments when the world panicked and we were prepared. Volatility wasn't our enemy, it was our ally. This philosophy wasn't just unique, it was groundbreaking. While most investors feared downturns and market crashes, Artradis thrived in these conditions, turning volatility into a lucrative opportunity. The financial world took notice. Artradis became the darling of the hedge fund awards circuit, winning titles like Best Asian Hedge Fund and Fund of the Year in back-to-back years. By 2008, Steve Diggle and his business partner Richard weren't just hedge fund managers, they were legends, securing spots on Forbes' Wall Street 20 highest earners list, with each pocketing an astounding $90 million in a single year. But this wasn't just a story of numbers and success. Artradis was a symbol of what could be achieved when financial innovation met a willingness to take calculated risks. At its core, the fund was an embodiment of Diggle's philosophy, betting big on chaos, preparing for the unimaginable, and profiting from the rarest of market movements.
The worst day on Wall Street since the crash of 1980.
The sell traders are standing there watching in amazement, and I don't blame them.
We're now down 43%. Almost everything there completely wiped out. In the NASDAQ, everything and more has been completely wiped out.
Let's talk about the speed with which we are watching this market deteriorate.
Little did the world know, the real test for Artradis was just around the corner. The financial crisis of 2008 loomed large, threatening to bring global markets to their knees. But for Steve Diggle and his team, this was no catastrophe. It was the ultimate proving ground. The thrill of volatility trading.
2008, you had something close to a bubble in home real estate. 50 million people had mortgages roughly at that time out of 75 million homeowners. When that bubble burst, it hit home to probably 40% of the households in the country, these people that had mortgages on their houses. And fear spread in the month of September 2008 at a rate that was like a tsunami.
2008, the world's financial markets are in freefall. Major banks are collapsing, stock markets are plummeting, and panic is gripping the global economy. For most investors, it was a time of fear and devastation. But for Steve Diggle and his team at Artradis, this was the moment they had been preparing for. A moment of unparalleled opportunity awaits.
You know, once we sell, we'll be just like the rest of them. You know that.
No, we're not. We're not the bad guys here. We didn't defraud the American people and prey on their dreams of owning a home. All right, they did.
Now we get to kick them in the teeth.
But we got to close out our position or it could be zero. I mean, it's now or never, Mark.
Sell it all.
Turning chaos into cash. While others scrambled to protect their losses, Artradis thrived. Thanks to their expertise in long volatility trading, their strategy wasn't just to survive the storm, it was to profit from it. They had designed their flagship funds, Barracuda and AB2, to leverage the very chaos that was shaking the global economy. Long volatility trading is about preparing for the unexpected, those rare extreme market movements that most investors dread. Artradis used sophisticated tools like over-the-counter options, variance swaps, and credit default swaps to bet on the sharp spikes in volatility caused by the market panic. Take credit default swaps. For instance, these financial instruments allowed Artradis to profit when banks under extreme stress struggled to meet their obligations. In one legendary trade, Artradis purchased swaps on Lehman Brothers for a fraction of their eventual payout. When Lehman Brothers collapsed, those swaps paid out 367 times their initial costs. Yes, you heard that right. 367 times return. But it wasn't just Lehman Brothers. Artradis made similar stunning returns on UBS and other institutions. These weren't just lucky bets, they were calculated plays based on years of meticulous planning and analysis. Artradis didn't merely react to the crisis, they anticipated it, positioning themselves to exploit the vulnerabilities in the system. The 2.7 billion payday. By the end of the crisis, Artradis had delivered an astonishing 2.7 billion in profits to its investors. This wasn't just a windfall, it was a validation of Steve Diggle's philosophy, that chaos breeds opportunity for those who are prepared. Steve Diggle said in an interview 2008 wasn't just about making money, it was about proving that risk could be managed, harnessed and turned into an advantage. We showed the world that volatility wasn't something to fear, it was something to embrace. Diggle's perspective wasn't just bold, it was revolutionary. At a time when many hedge funds struggled to stay afloat, Artradis stood as a beacon of success, mastering a strategy that most considered too dangerous to touch. Artradis became the darling of the financial world. Industry accolades poured in, Best Asian Hedge Fund of the Year, and a host of other prestigious awards. Steve Diggle and his partner Richard cemented their legacy as pioneers of volatility trading. They were the kings of chaos, thriving in a world where others fell. The art of managing tail risk. At the heart of their strategy was a concept called tail risk, the chance of rare extreme events occurring. While most investors avoided these unpredictable scenarios, Artradis actively sought them out. Why? Because when these events did occur, the rewards were astronomical. It was a high-stakes game, but one that Diggle's team played to perfection. Imagine the Archidis trading floor during the height of the crisis. The global markets were in turmoil, yet Diggle's team was calm, focused, and prepared. They weren't reacting, they were executing a strategy they had meticulously designed for years. Every spike in volatility, every dip in market confidence, it all played into their hands. For Archidis, chaos wasn't a threat, it was an opportunity. But as triumphant as the results were, Diggle knew the dangers of volatility trading all too well. It's a double-edged sword, a strategy that could lead to massive losses if not carefully managed. Yet, they consistently found ways to mitigate those risks, delivering results that seemed almost magical to outsiders. Steve Diggle said, "It's easy to call volatility trading dangerous, but the real danger is ignoring the risks you don't see. We didn't gamble, we prepared, and when the time came, preparation met opportunity." 2008 was their finest hour, a moment that proved Steve Diggle's daring vision could not only survive in the toughest of storms, but come out stronger than ever. Success, no matter how grand, is never immune to challenges. For Archidis fund management, the very volatility that brought them glory also became their Achilles heel. The financial world changed rapidly after 2008, and even the kings of chaos were not spared. With the aftermath of the 2008 financial crisis brought not just recovery, but sweeping changes to the financial landscapes. Central banks around the world intervened with unprecedented measures, slashing interest rates, injecting liquidity, and stabilizing markets at any cost. These actions slowed volatility, the very lifeblood of Archidis' strategies. For a firm built on profiting from sharp market swings, this new era of calm was a slow creeping challenge. As the years passed, investors' withdrawals mounted. Assets under management plummeted from $4.7 billion at its peak in 2008 to just $800 million by 2010. The flagship funds Barracuda and AB2, which had once delivered stellar returns, began to falter. Losses accumulated, 27.5% in 2009, 23% in 2010 for AB2, while Barracuda suffered losses declining nearly 29% over the same period. Investors now grew restless and began pulling their money. By early 2011, it was clear that Archidis of old could not thrive in this new intervention-driven market. Steve Diggle and his business partner Richard made the painful decision to close the firm. But they did so with a sense of responsibility that set them apart from many others in the industry. Steve Diggle built the hedge fund on a foundation of trust, and they weren't about to break that. Their investors stood by them through thick and thin, and they deserved to walk away with their capital intact. In one of the most remarkable aspects of Archidis' closure, every investor received their capital in full. No gates, no restrictions, just a clean and honest wind down of operations that was almost unheard of in the hedge fund world, especially for a multi-billion-dollar firm. Shutting down was never about failure. It was about knowing when to pivot. Markets had changed and we had to change with them. Archidis was a chapter, a spectacular one, but it wasn't the whole story. For many, this would have been the end of the road, but not for Steve Diggle. In 2011, he founded Volps Investment Management, a family office with a diversified portfolio and a fresh vision. This was no longer about chasing volatility alone, it was about building something sustainable, something resilient. Under his new investment management firm, Diggle ventured into uncharted territory. Biotechnology, real estate, and even avocado orchards become part of his portfolio. It was a bold shift, but one that reflected his ability to adapt and innovate. Diggle's invested into UK-based biotechnology firms like Scancell and Oxford Biomedica. These companies, often overlooked by large investors, found a critical lifeline in Diggle's backing. Diggle wasn't just chasing profits, he was enabling breakthroughs that could change lives. Looking back from the fall of Archidis wasn't just a challenge, it was a turning point. It taught Diggles the importance of diversification, resilience, and always being prepared to pivot. The same sharp instincts that helped him navigate volatility now guided him in building a more balanced and forward-looking portfolio. Steve Diggle said, "Sometimes the best opportunities come not from success, but from learning to rebuild." Archidis taught him the value of knowing when to let go and when to start again. Biotechnology was just one piece of the puzzle. Diggle also ventured into German real estate, capitalizing on the stability of Europe's largest economy, from urban developments to commercial properties. They expanded into tangible income-generating assets that balanced the portfolio against market fluctuations. And then there was something no one saw coming: avocado orchards. In the lush landscapes of New Zealand, they invested into sustainable agriculture, recognizing the growing global demand for healthy organic produce. It was a move that showcased Diggle's ability to think beyond the traditional confines of finance. This portfolio was designed not just to weather storms, but to thrive in any market environment. One of the most important lessons Diggle's story teaches is the value of preparation. Archidis thrived during the 2008 financial crisis because it anticipated the chaos. By betting on tail risk strategies and volatility, Diggle proved that with the right approach, even the most turbulent times can be opportunities for growth. But the story didn't end there. The closure of Archidis was a stark reminder that markets are always evolving, and strategies that work in one era may not work in the next. For Diggle, this wasn't a setback, it was a chance to pivot, to learn, and to grow. Adaptation isn't just important in finance, it's everything. Market change, economic shift, and as an investor, you have to be willing to evolve with them. Steve Diggle's story doesn't end with the accumulated success or the lessons learned from Archidis. Today, as the financial world faces growing instability, Diggle is preparing for what could be his most thrilling chapter yet: a return to volatility trading. According to Steve Diggle, global markets are showing signs of strain, from stretched valuations in the US stocks to mounting geopolitical tensions in Asia. The conditions are eerily a reminiscence of the lead up to the 2008, and Steve Diggle is once again positioning himself to thrive in chaos. At 60, Diggle isn't just stepping back, he's stepping up. With Volp seeking to raise $250 million for a new fund, Diggle is making his biggest push into volatility trading since the closure of Archidis, but this time he's armed with cutting-edge tools, including artificial intelligence models that can analyze vast amounts of data to identify companies at risk of financial collapse. From identifying corporate blow-ups in Asia to betting on market swings, Diggle's new fund is poised to profit from the very volatility that others fear. Steve Diggle said, "The number of fault lines in the market today is greater than he's seen in years, from shadow banking issues in China to the unsustainable heights of US tech stocks. The risks are mounting. We're in a situation that feels a lot like 2005 to 2007, and that's when you prepare." Diggle's strategy is clear: hedge against market crashes while taking bold, calculated bets on stocks and indices in calmer periods. His focus isn't just on surviving volatility, it's on making volatility his greatest ally once again. From Hong Kong to mainland China, the Asia-Pacific region is at the center of his latest ambitions, with Diggle aiming to dominate the next wave of market opportunities. Diggle's comeback isn't just a financial play, it's a statement. It's a reminder that even after decades in the game, he remains one of the sharpest minds in finance, ready to navigate and capitalize on the storms ahead. For the next generation of investors, it's a powerful lesson. No matter how calm the water may seem, volatility is never far away, and fortune favors the prepared. Steve Diggle isn't just coming back, he's proving that his ability to adapt, innovate, and thrive in volatility remains unmatched. As he raises the stakes one more time, the financial world watches, knowing that when the next storm hits, Diggle will be ready. So the question is, can you dominate the volatility that Steve Diggle is preparing for? If you want to find out more about the volatility index and how to dominate volatility in the markets, then check out my VIX trading course in the description. This will break down how to understand the fear index, how to take advantage of that, and how to profit from volatility. I hope you've enjoyed this video. Click here to check out the next documentary.